everybody. Welcome to the Sense of Things podcast. Myself, Jeff Kikel, and my co-host, Ron Lang. This week, we're going to just riff a little bit on the economy, talk a little bit about what's going on in the markets. I'm going to kick it off with Ron, though. What's going on, buddy?
I got to tell you, there's been some good pop culture stuff that I think should percolate some conversation. This isn't just talking about the economy and the markets. It's also talking about business, successful businesses with brands, which I know you can appreciate. So let me just kind of share something with you. Everybody recognizes this car.
Oh, I heard a little bit about this.
Oh, yeah. Hold on a second. So here's the fun part. So I saw this article yesterday and I had to do a little research because I was actually curious. 1936, Oscar Meyer built a car in the shape of a hot dog, and it is recognizable no matter where you go. I've seen it in Phoenix, Philadelphia, Jersey. I've seen it all over. And it was very interesting reading a little bit about the history of it. So they called the car the Weinermobile. Apparently, after 87 years, there was a problem calling this car the Weinermobile. Yeah. Now, yes, it looks like a phallic symbol on wheels. That's not the problem. The problem was the name Weinermobile. People today, in this day and age, can't handle the name Weinermobile. So what's going on? They're changing it to Frankmobile. Can you please help me with this? First, it was Aunt Jemima. Then it was Uncle Ben's. Now we can't even call the car Weinermobile.
Plus, we had to take out the Native American lady on Land O'Lakes, the butter too, because had to take that out because I'm sure one person complained.
You're correct. And a lot of people don't know the following. Are you a Starbucks person?
I am a Starbucks person.
Did you know they changed the logo? You know how they have the mermaid as part of their logo?
Yep.
The original logo with the mermaid, and you could look this up, was actually exposed breasts. And then eventually what they did is they moved the hair over her chest later on because people couldn't handle that either.
Yes. And now we have the Frankmobile.
And now we have the Frankmobile. Thank God, Jeff. Thank God we could finally move on with our lives because it was affecting kids everywhere.
They were running, screaming from the Weinermobile, and now that they will embrace the Frankmobile much better. Wow.
Another quick fun fact I was reading about it. So the drivers are called hot doggers.
Okay.
And what they do is they hire college seniors. Their seniors are about to graduate, and they have to have certain criteria in order to be a hot dogger to drive the Weinermobile around the country.
Around that, I actually watched an episode of Jay Leno's Garage where it was the new class of kids that were getting out of school that were going to be hot doggers driving the Weinermobile, and he got to drive the Weinermobile around Detroit, I think it was, or something like that. So I'm
not gonna lie, I'd like to take it for a spin.
I think it would be awesome. Yeah, I guess he had to do the test that they require, which they have to learn how to parallel park the Weinermobile and all that. It was a nightmare, but yeah, because you can't see behind you, and it's just
they probably put in a rear view camera at some point, right?
I'm sure probably what they're going to need to do, even though it's called the Frankmobile, it'll probably have to be covered over with a tarp or something like that, because
apparently that's not the issue though, Jeff.
It's just the name.
It's the name. They can't handle the name. All right. What are your thoughts about what's going on in the market?
I tell you what, I'm always the economic weenie of the group, or the economic nerd. I always watch economics, and I was just going to share something that I was just in my opinion of what's going on a little bit here. Let me share a slideshow here. So I'm looking at the economy from two pieces, and we've been talking about, all right, what we both feel like we're heading into a recession. It's interesting to me that it's like the frog boiling in the pot. You look at the housing market index, actually consensus, and this is all off of Econoday. If anybody ever wants to go look for it, it's econoday.com. Back in the day, it used to actually be a physical calendar when Ron and I started in the business. Now it's all online, but they just basically go through and they give you just a quick little hit on everything. And so we look at consensus for the housing market index was a 45. Consensus range, this is basically all the economists they survey. and it was a 43 to a 46. It comes in barreling in at a 50, which is actually not bad considering where interest rates are and all that. We look at housing starts and permits. We're right on the consensus there. Everything's good. You look at jobless claims. Actually, jobless claims were less than the consensus and really outside of the range. Lower is better here. So all of that saying, all right, we see positives. Retail sales this week were basically right on track, almost a little bit better in those cases. But then you start to look at industrial production. Okay, that's doing great right now. We're producing, we beat the consensus in a lot of these areas. Capacity utilization is hanging in there and is in the consensus range. And that capacity utilization just means how efficient is the industry. If you looked at this about a year ago, it was down in the 60s, which that meant a lot of people coming back into the workforce were not well trained and they were reducing productivity. So productivity has come back, industrial production has come back. Then you start to look at business inventories. So this is now taking it out of the consumer side of the market and going into the business side of the market. Business inventories, prior month, 0.2%. This month, consensus was, they'd be about 0. Boom, we're down. Still within the consensus range, but we're down. You look at the Philadelphia, hang on. This is the Philly Fed Manufacturing Index. It's just a little off the screen here. It was better than what it was expected, but still pretty significantly down. And I think the biggest one of the whole thing, Empire State Manufacturing Index, prior was 10, consensus was -2. It came in at a -31.
Yeah.
That tells me that businesses are starting to hunker down pretty significantly. And with them hunkering down, that just means that it's not going to necessarily be good for the consumer side of things if the job situation gets worse, if these manufacturers start laying off or cutting back on production.
Yeah, I saw many of the same numbers, and I thought what was interesting, when you're looking at economic trending and things like that, the big thing is that the jobless claims went down. That means the economy is still hot.
Yeah.
And I believe at this point, and I felt this way a couple of days ago when I was looking at some numbers, I think there's at least a 50% chance that they raise rates again in June.
I think so too.
25 basis points.
Yeah, it falls under that line. Okay, if you're looking at, all right, jobless claims are going down. Okay, that means that things are still humping along. I can very well see it happening, and I could probably see at least another 2 raises this year.
Well, hey, look, inflation isn't going up, and it may be going down slightly, but it's still high.
Yeah.
And that's what the Fed is focused in on. All the other factors is noise to them.
Yeah.
They're focused in on inflation. So if the jobless claims are going down and it's still a hot market, I don't see them stopping or even really pausing for a meeting or two. We'll have to see what happens. A couple of things I just want to go through here. More of them are about a continuation of last week's conversation as far as the concentration of the market.
Yeah.
And we were talking about the top 8 stocks of the S&P 500 essentially having a larger market cap than the other 492. Here's a heat map. So my source on this is finviz.com. I've been using them for 15 years. They got a lot of really great stuff. If you're the type of technical weenie and fundamental weenie that really likes digging deep in the weeds on stuff, Finviz is a great website. They have a free version and then there's a pay version. But you could see in this heat map just where, as far as market cap, where a lot of stuff is. And I know we had briefly spoken about this earlier prior to our podcast, but I think right now people are just riding momentum. They're seeing the top 8 stocks moving up. They're taking money out of the rest of the market. They're riding up those 8 stocks, and that's what's propping up the price of them. When does the music stop or slow down? I don't think anybody knows the exact timing on that, but my God, I think we're coming to the end of that cliff on a significant pullback. 5% minimum, 10 to 15% more likely. But my goodness, I just cannot believe quite frankly, the solid market action that's going on. We'll have to see.
Last couple of days especially. Yeah.
Absolutely. And I thought the other thing that to foster some conversation, now we've been talking about a lot of these things in the last 5 or 6 weeks, but I thought for a lot of people to do more of a summary screen here of immediate headwinds. Everybody's, ad nauseum right now with the debt ceiling talk, positive conversations. Yesterday, the 17th, pushed the market up. Folks, we're not going to default, but maybe we'll have a government shutdown. Who knows? But a lot of people don't realize that even if the president and the speaker comes to an agreement, it still has to go back to their parties, which could take another 5 to 7 days to get into agreement and then come back and pass it. So even if there's a positive headline that they came to an agreement, doesn't necessarily mean that it may pass, especially with the left and the right having such extremists on either side. They may try and hold out just to stir the pot a little bit more. We'll have to see. One other quick thing I wanted to mention, because I'm not going to go through every bullet point here. Back in December, I did a market outlook for 2023, and I had a chart in there talking about how credit card balances just went above the $925 billion mark. We talked about it a few weeks ago, how it was inching up past 950. It's just breached $1 trillion.
Wow.
So people are spending money they don't have. At some point, that's got to break. Credit is tightening at all bank levels, specifically the mid-range and the small banks. Now, they may be lending to say that they're lending, but they're capping off the amount of people they're lending to. We got another possible Fed rate hike in mid-December. The other thing as we go down there is, I don't know about you. I know in Texas, gas is still at a pretty low level. Arizona, I think, is the second most expensive state in the country. My God, where I get plus in my car, it's at 555 to 560 a gallon. That's only going to go up as we get in deep into the summer months.
Unleaded for us is
contrarians. What a lot of the contrarians are talking about, and your numbers were just showing that, is we still have low unemployment. The consumer spending is still very strong. And the big thing, travel and hospitality not only have shown strength, but their bookings are near pre-COVID levels, and in some cases
above.
Beyond.
Yeah.
So is that what all those credit card balances are? Is all this travel and hospitality? It should be interesting to see. I know a lot of your numbers coincide with some of these things that we're seeing on the tailwinds, but you can't ignore those headwinds.
Yeah. Like I said, I remember what we talked about last week on the show about off the First Trust high frequency report. And it was interesting to see that it was the consumer was cutting back on some of the discretionary things, but international flights are at the highest number. They're actually higher than they were in 2019. The hospitality side it hits your numbers right there. They're off the charts on the hospitality side. So I think personally, that's where the spending is going, is people they were trapped for basically almost 3 years, and they're just not going to. And I've just talked to some friends of mine, just got back from 2 weeks in Italy, and they've never been to Italy before. And multiple people that I've talked are heading overseas right now, which for United States, for people from the United States, it's actually very affordable over there now because the euro and the pound are down. But our dollar's been down 20 to 30%. So when you go overseas, when you're going international, what is your true buying power if our dollar is down against the rest of the world currency? Yeah, it was still better than the last time I was over in Europe. It was, I think the pound was 88 cents to the dollar, or 88. I think we're close to par now. Yeah, probably closer to par, which it was actually very affordable, I thought. Interestingly enough, their prices had not gone up much more than when I was over there previously, though. When you knew it in pounds, it was actually pretty reasonable. Now it's probably, like I said, the dollar's declining, so it gets more and more expensive when you go over there. But interesting, though, I just think people are saying, screw it, I'm just going to go get overseas and enjoy myself, because I didn't get to for several years. Look, we're recording this on Thursday, May 18th. The next 2 to 3 weeks is going to be
Very interesting to say the least, as far as which way the market breaks. We're done basically the majority of Q1 earnings. Certain parts were certainly strong, but actually it's amazing how some of these software actually monitor the transcripts of the corporate earnings announcements, as they said the highest ever since 2008, 2009, that the word recession was mentioned in corporate announcements over the last, 5-6 weeks.
Yeah. Which, when we look at the Philly Fed and the Empire State Manufacturing, it says it exactly. All those guys are pulling back. And right now they're pulling back production. When do they start to shift into, okay, we've got to start cutting staff? Yeah, you cut production, you're going to eventually have to cut staff at that point.
Look, I was talking about June for the precipitous cutting with staff, because people are just saying, look, many businesses are just very slow or dead over the summer. That may be the best time to start chopping heads and cutting costs and going into Q3 and Q4, where there's probably going to be a recession, as I've been saying, in the September, October timeframe. So maybe we were just a little early talking about a pullback in early mid-May, but by the summertime, based on cyclicality and seasonality and things like that, that's when the dam may break. We'll have to see. But again, it's not something I'm wishing for. I know I always sound like a fear monger here, but hey, we, like you know, when you're responsible for other people's well-being, you'd rather be more cautious than throw risk to the wind.
Yeah, it's exactly right. And even though 8 or 9 stocks are running roughshod and running the market up, I just am not willing to chase that market at this point. I would rather be diversified out in some other areas that I feel are just a little bit more stable and safe as we roll into whatever's coming. And like we've talked about before, I'm a big follower of the leading economic indicators. And to me, looking at the chart of the leading economic indicators right now, we just launched an episode that I did just on the leading economic indicators to tell people what that is. So if you want to know about that, go to the channel and watch that one. It's really short. It's probably about 7 or 8 minutes of me sharing what that is. Once again, if I were to look at the chart and I look at history, I would say right now we are sitting in the middle of a recession, and it just hasn't been reported yet because recessions are reported backwards and we're just not there yet. So I personally believe we are in a recession as of today.
Yeah, they always said by the time the economic numbers show us that we're in a recession, we had already been in it 3 to 6 months.
Yeah, exactly.
And actually, I think what we're seeing right now is the absolute direct effect of the Fed rate hikes from last summer. Yeah, because they said years ago, and a lot of people don't realize that, they think if you raise the rates, right, there's an immediate effect. There's actually a 6 to 9 month lag, but I think what we're feeling is a 9 to a 12-month lag of those effects right now. So I could not believe when I saw the numbers. There's like a 30 to a 40% chance that the Fed would cut rates before the end of the year. The only way that could happen is if unemployment doubles. Hey, oh my God, hey, we went too far with the raising, now we got to cut. At the end of that's 6 months away. I just don't see how those numbers jive at all.
I'm with you. And I think the Fed's kind of walking this real tightrope right now, because you can easily throw the economy into stagflation. You can still have inflation hanging out up here and stagnate the economy. And then they're caught between a rock and hard place. Because if you raise rates anymore, okay, rates go up and maybe it slows inflation down a little bit, but it makes the economy worse. Or if they drop rates, it could light a fire under the inflation rates again. So I think they're in a very difficult situation. And I think they're very much aware of, we've got to slow that inflation number down. And hopefully we can get a debt agreement that we always are going to raise the debt ceiling. It's going to happen. The biggest issue, I think, is getting some spending cuts, stop fueling the economy more with dumping money into the economy. Let's slow it back a little bit, pull back some of these areas that we don't really need to be pouring money into right now, so that we can keep that portion of the fire from going any higher at this point or
Well,
staying up there.
I think we could wrap it up on some very simple, logical, rational analysis about inflation and the Fed rate.
Yep.
The inflation rate is hovering, give or take, right around 6%, somewhere around there, I believe, maybe a little bit lower. How in less than 6 months? Here, let me take a half a step back. What does the inflation rate have to be in order for the Fed to say, okay, we've done our job, now we could lower rates?
Yeah.
Do you think inflation? I think inflation has to be near 4%, at least, if not under 4%, for them to go, okay, we're moderating rates. We're either pausing completely or maybe we have to raise it, lower it 1/4 point. How is that going to happen in the next 4 to 6 months?
It's not. It's just not possible. And the Fed's target is 2, which I don't see that happening for years down the road. Things are going to have to get a lot worse to get to 2. I think that they say 2, but I think their number is 3. But until they even saw it decline down to 4, I don't even think they would begin to think about slowing down on this. They might pause for a few months, see how things are going. Once again, everybody was talking about there's all these bank defaults and all that. It was interesting. I did an interview about 2 days ago for my other show with a gentleman that he basically designed some software to help people find commercial loans. And he had an interesting insight. He's been in the mortgage and loan business for 30 years. He got wiped out during 2008. And I asked him the question, and I think I may just take that little piece of the interview and throw it up on our site here. But he was very insightful that he's like, yes, things are drying up a little bit, but there's still a lot of money out there that banks are willing to loan.
I agree, but the credit is tightening. Actually, I didn't add the bullet point, but apparently in the last 30 days, there has been a significant spike in small business bankruptcies at the highest level, almost matching 2008, 2009.
Yeah. I think that number's been that way since January of this year.
I get it. Yeah. It's a recent, literally, it's a parabolic spike. But it should be interesting here to wrap it up because I got to check the dates. But I believe the CPI number comes out before the next Fed meeting. And I think this time it was the other way around. The Fed meeting was out before the CPI. So they're going to have that one more data point before that meeting. So it'll get interesting.
They'll basically have 2 data points before they're going into it. So it's going to be very intriguing.
Yeah, unemployment and the CPI.
Yeah, correct. Absolutely.
All right.
Good, man. I think we covered it for this week. And folks, make sure you subscribe to the channel. We're putting out a ton of content right now. We're trying to stay on top of this and give you our opinions of what we see going on for whatever that's worth. I think both of us are very data dependent, and that's how we make decisions. And hopefully this helps you to understand what's going on. Subscribe to the channel, hit the notification button so you get notified when all this happens. And absolutely feel free to comment and share. We would love to know what your thoughts are on this, what you would like to see and hear. And we will certainly respond to that by making sure we cover that in the shows. So thanks a lot. And we will see you guys here back the next time.
Be well.